On this channel, we've analyzed over 100 stocks, and I've kept a list of the ones that I believe are worth investing into and kept track of what a fair value, our undervalued and our overvalued prices would be, as well as what the annual returns would be based on our thesis, and try and come up with a good time to buy some of these stocks. And we're halfway through the month of March, and five stocks are within the range where it might be reasonable to at least start initiating a position or selling puts or considering starting a position. So these five stocks are PayPal Holdings, ticker PYPL, Intuit Inc., INTU, Birkenstock Holdings PLC, BIRK, Steel Dynamics Inc., STLD, and Generac Holdings Inc., GNRC. I just came out with the Generac video the other day. I did the Birkenstock video when they had their IPO, and over the last few months, we've taken a look at STLD, PYPL, and INTU. You can go and check all of those videos out to see what the thesis we came up with, the trend for the company. This specifically is looking at where the market currently sits on this stock and what I'm doing to initiate my positions. So starting with PayPal, we see that undervalued is 96 and it currently is 62.85. So clearly it is an undervalued stock. The market has been hating on it, and a turnaround is really what we're expecting on this one. This stock had fallen all the way down to just about $50 and is already on its way back up. If we zoom out to a longer term view, you can see that it was overvalued based off current financials back in 2022, April. So 2 years ago, it was $120, and right now it's sitting just north of 60. So cut in half over the course of 2 years. And you can keep going back and see that it hit a peak of $310 back in late 2021. And these valuations really do not seem too unreasonable. Seems to have a strong floor right around that $50 level. Right about 56.5 is a pretty solid floor. It's touched a lot, dipped down that little bit off the earnings back in October, but since then it's been on its way back up. And so this is a stock that I've been selling puts at. $48 has been the typical put that I have been targeting, where I would not mind holding this stock for less than half of what I think that it's actually worth. And it's proven to be a pretty good strategy. Started trading in January, and so far, January I made $29, February 81, March 43. So nothing too crazy, but that is not bad for a time frame where the stock's up $6 over the course of that time frame, and I've pocketed $151 in premiums. Even if I had bought 100 shares, I've more than doubled the return that I would have gotten by just sitting in those shares. And looking back at our sheet, we see that PayPal is currently $50 undervalued, which amounts to almost 80%. Annual return based on our thesis. Go check out the video if you want to see how we come up with that. So if we take the percentage off the fair value plus the annual return, so we say within a year's worth of the valuation, we'd be coming up with 89.5% returns, which is clearly the best on our list, one that I'm very interested in and going to stick with. My current strategy has essentially given me 2 shares for free, and I want to keep doing this. If it goes down to 48, then based on how the company looks right now, I would definitely be willing to buy 100 shares. Next up, we have Intuit. Intuit is actually kind of overvalued. It's above the fair value, not quite to the overvalued range. So it's 8% overvalued, one of the better ones on our list. But annual expected returns, again, go check out the video for the thesis there. We're looking at 14% with a 0.6% dividend. So about 7%. That's in line with markets. That's not incredible, but it's definitely worth starting to think about initiating a position in this stock. It's another one where I've been doing put credit spreads on, and in February I made $65 in premium, and in March 54 so far. So in total over those 2 months, $120. Not too bad. It definitely doesn't put a dent into a single share there, but it is something that'll help drive more cash flow to the portfolio. Next up, Birkenstock Holdings. I liked how it looked when it IPO'd. It currently sits at 47. Fair value I'm coming up with is 46, undervalued 35, overvalued 51. So right now it's just slightly overvalued, $1 above the price that I believe is fair. But the annual returns based on how they've performed recent off their recent financials, 13.5%. Definitely a huge growth stock here. Second on this list only to Intuit. No dividend as of yet, but that amounts to about 11% returns. One of the lower ones on this list, but probably one of the more likely ones, because next up, Steel Dynamics is undervalued. Its price is starting to approach that undervalued price. So it is currently $38 below the fair value, 27.5% below. Things could change. It's definitely a more of like a cyclical, commodity dependent stock where the annual returns are pretty small, 4.22%. So it's one where you get in because it's undervalued, and if it does not approach that value quick enough, you might be losing out a little bit. But still, but it does have one of the strongest dividends on this list. And so it amounts to about 33% returns if it can realize that fair value. It's definitely been on a nice trend upward. I'm not really trading this one. I do have a few shares, and I'm just riding it out for that one. I don't know that I'd really want to buy more. It's definitely a initialize a small position and get some exposure to the industry and the commodity. And then Generac Holdings. Just did a video, my last video out. Currently $44 undervalued. The price is sitting just north of the price that we would want to get into the stock at. Annual returns in line with market, almost 8%, and no dividend there. So that amounts to 47% returns. And that was another one where, if you look back over history, it's been at super high price. It's been as high as $524 back in 2021 and saw a pretty big decline since then. It bottomed out right around $80 October of 2023. So this is looking really similar to PayPal, graph wise. And since then, it's gone up. It's kind of leveling out at this level right around the 110 zone. I'm currently riding a 110 put, so we'll see what comes out of that. But I just looked into it the other day and haven't had time to do much more than that. So far, I'm sitting on $28 in premiums on this one. So about a quarter of a share. And that's all for the undervalued stocks that I'm looking at right now. I'm trading on all of these. I have an open put on, or a cash secured put on PayPal, Birkenstock, and Generac. It's TLD, like I said, I'm just kind of waiting it out, holding shares. Intuit, I do have a put credit spread because that is a very high share price there to be doing a cash secured put on. And I'm taking a portion of the premiums that I make and I'm putting it right into the shares because these do look like some of the better opportunities in the market at this time. There are only two others on the list that they don't have great returns over the next year, but at least they're not negative. we do have quite a few negatives, and we'll take a look at the worst of those, the ones that I would really avoid buying at this point. Not necessarily selling, but definitely buying. So S&P Global, SPGI, is currently 5% overvalued, annual returns of 9%, a dividend of 0.86. So about just shy of 5% returns over the next year. And then Amazon, their price is 14% overvalued, annual returns of 17.9%, no dividend there. So right about 4% returns. So those ones are ones to keep an eye on. If they drop, they might make this list. If not, then hopefully you were able to get a trade in and make a bit of premium as it rose. But now if we look at things the other way, things that are not worth buying now and are incredibly overvalued. Snowflake, first and foremost. I do love the returns here. It's one of the best ones that we've looked at on returns. It's just so overvalued. Their value of $52, price of $156. So I'd sit and wait on that one. I mean, I have done some call credit spreads on that because I think it's so incredibly overvalued and made some decent profit off of that over these last few months. $24 in January and $22 in February. So definitely nothing insane. That's the combined almost $50 over 2 months. So not even the fair value that we're looking for on this stock. Fair Isaacs, again, really good returns. One of the better ones that we've seen. It's just so overvalued, almost 54% overvalued. If there's a crash in the markets at all, it'll probably come down pretty quick. Ferrari, ticker RACE. Again, love the returns on this one. It's just so incredibly overvalued. 26.7% loss over the next year. Ulta, I'm going to have to run the numbers on Ulta again after their most recent earnings. They were on the list to buy, but they've run up so quick. I put a video out. I gave it a buy rating, and I personally bought some shares at $360. It's $536 as of today. And just the other day, I believe, before those earnings came out, it was in the 600s. So it's doubled very, very quickly. And probably a lot of this is momentum. It will likely come back down, but I'll have to rerun the numbers and see if there's reason for it to stay this high. It has been at least a quarter since we last looked. Microsoft, one of those where there's never a good time to get into Microsoft. Great returns, tiny dividend, but 22%. Again, if the market crashes, that's not a loss that I'm really wanting to take. So I'll stay on the sideline. I do own a little bit. I've done some trading. I thought it was a little high. Bought a little bit just in case because I held it long ago in the past, and I wish that I had held on to it. But we'll see how everything plays out with that one. So those are the 5 worst of the stocks that we've looked at, where if the market starts to turn, the valuations on these ones are a little high and multiple compression might hurt a little bit. And then there are some stocks in between. And anything else that's not on this list, I didn't really think was worth monitoring, at least not yet, because at a minimum, I want returns in line with the market, 7 to 10%. And if they can't meet that, then they don't make this list. They might be on a list to take a look at again in the future when they have more earnings, but I don't want to waste too much time on them. So I want to thank you guys for watching. Hopefully you enjoyed this video. Please go check out all of the videos where we come up with the thesis for the annual returns for these companies. Subscribe because I think I might do this every month. We'll see how the list changes. It could be a few months in a row where it's the same stocks. Like the video if you enjoyed it. Let me know that this is a something that you check out in the future?